So I'll introduce here from my left over. We first have David Reed, and he is the Managing Director of Development for Middleburg Communities. Next to him, we have Judd Bobilin. We practiced the last name, so I think I nailed that. He's with Chance Partners. He is principal and founder. And then to the far left, we have Tim Graney with Mattamy Homes, the U.S. VP of Finance. So before we really get into the overall content, I'd love if you guys could each give just a little bit of overview on your company and the markets you're working in and the type of product in which you work with.
Sure, I'll start off. At Mattamy Homes, we're a residential home builder. We operate in 9 markets, primarily in what we refer to the sand states. So those states that have high in-migration rates, North Carolina, Florida, Texas, Arizona. We tend to offer first-time home buyers, active adult. We stay out of the luxury market, so we're more of a production builder. We do about 4,000 homes a year, and that ranks us about 20th in the Builder 100.
Chance Partners, we're a multifamily, strictly apartment development, mostly in Jacksonville, Orlando, and eventually into Tampa as well, just like that corridor. We've got 3 projects currently under construction, so I was listening to what Casey was saying earlier and trying to figure out how to delay but not get any cost increases. But overall, the market is pretty good right now, and we look forward to the future in Florida.
Yeah, Middleburg Communities, we are based out of Virginia. I run the Florida division. We are a vertically integrated rental, multifamily, single family for rent company. Been around since 2004. We're really just starting to get into the single family. We've done about 22,000 in acquisitions and new developments in the past. Since 2004, over $3 billion worth of transactions. And in Florida, we're active from Jacksonville down I-95, I-4 through Central Florida to Tampa and down 75 toward Fort Myers. Doing both multifamily, like Chance, and single family for rent. Cottages, duplexes, townhomes.
So the NAHB just released a statement a few months ago saying that they anticipate that permits will be down about 26% for single family and 28% for multifamily this year from last year. How's that resonate with what you all are planning for and what you're anticipating for the year ahead for your business?
At Middleburg, we've got 3 projects under construction right now. 2 of them are actually multifamily, but one of them is the single family for rent. We see this opportunity of things slowing down and everybody's kind of trying to figure out what's going to happen this year with the economy and interest rates, et cetera. But we see this as an opportunity to build up our pipeline for 2024. So we're actively in different stages of entitlements, rezoning, PSA negotiations on probably 8, 9 other pieces just here in Florida. We're active in Virginia, the Carolinas, Atlanta, Georgia, Texas, Alabama, and here in Florida. But I'm primarily responsible for Florida.
So no slowdown anticipated on your side?
No slowdown for us. We're closing today on another property we're building over in Tampa. So full steam ahead.
Okay.
Yeah.
Judd, Tim?
I think we take a little more cautious approach overall. We originally were going to start 3 projects this year, and we thought we'd space them out if we were smart by first quarter, second quarter, third quarter, but it never happens anyway. We've actually pushed our starts back until the fourth quarter, maybe even till the first quarter of 2024, just based upon where we think the economy is going and just a kind of a wait and see atmosphere. So we're very selective in what we do and how we look at land. We don't like to pay high for land, so any land sellers out there that's looking for 20 to 40,000 a unit, we're not the group that's going to do that. We saw a deal close the other day that was about 32,000 a unit, kind of shaking our heads as to how someone's going to make that pencil. But we're going to take a wait and see approach and see how the second half of this year is shaping up, and then decide if capital's free and construction costs are moderating or down. Then we'll look forward to going ahead and starting construction.
Tim, what about you guys?
I'll break that into two parts. So in terms of new construction of our homes, we're actually continuing to start homes at the same pace we had in the past. What we're finding is that buyers are tending to, as opposed to buying what we used to call a dirt sale or a to-be-built home, they're looking to buy a home that's within 30 to 60 days within completion. They're allowed, that allows them to eliminate any kind of interest rate risk. But from a land acquisition side of things, similar to what you've heard earlier, we're taking a more cautious approach. We're kind of waiting to see for the land sellers to kind of get real as to where the market is today. And it's beyond that. The land development costs have skyrocketed so much. And so, we were waiting for the land development costs to kind of come back to more industry norms before we make more large capital investments in land, in raw land.
And David, it sounds like, so I mean, among the three of you, that you're most aggressively pursuing land opportunities. Are you finding that in the conversations with landowners that there is any kind of compression on land values that we hope to see, but we have not seen? How are those conversations going?
Yeah, we're starting to see that. Several deals that we passed on where landowners were looking for $40,000, $50,000 a unit. That just doesn't work in today's economy. And we've all raised our yield on cost as well, our floor on that. But we're finding that they're coming back, and some of these deals are falling through. And that's why I say we're getting a little more aggressive during this next year, because we see some opportunities coming around. And we're picking up land now from 18 to 30,000 a unit, and that's still a challenge to get your six yield on cost to work.
Yeah.
With construction costs and everything else. And it's just taking longer to do deals now too. So.
Like they're just, oh, there we go.
Sorry, I zapped all the energy
just
there.
keeping y'all awake. So for the year ahead, as you look at these deals, how are you projecting out rent growth and also price growth compared to what we've seen, which has been pretty substantial?
Me?
Both, all of you. Yeah, I'd love to hear all of your perspectives.
I mean, I'll start with a little bit on the land. We are seeing that reduction, at least in some. I don't think it's capitulated completely, and so maybe it's another 6 months or so. As it relates to return on cost, that's how we measure all of our deals. We've adjusted from what was, when we had great cap rates that were in the sub-4 range, you could get a deal done on a sub-6 return on cost. So now, we're trying to be north of 6.5. If we get to a 7, that would be great. But obviously, cost of construction and the interest carry is a heavy burden, and so is insurance. I think that's an unknown, or not an unknown, but a known factor that I think KC had mentioned earlier is going to be a huge impact in the Florida market overall. So, those are big impacts. I mean, we look at our construction costs or our land costs. Land costs typically are 10 to 15% of our total budget. But you start breaking down those construction costs, 15% of those construction costs are typically framing. So, between material and labor, about 50-50 thereabouts. But wood is down, but it's about the only component in the building materials industry that's down. So the rest of it is still up extremely high. It's been increasing since 2010. So there's still challenges. Everyone likes to say, wood's down, you should be able to keep going forward. But that's just, again, it's only 15% of the construction cost.
I'll speak to the land side of things too. We're not seeing a lot of movement with land sellers. What we are seeing is an appetite to grant extensions, push the contract down the road, and they're looking at us taking a wait and see attitude. They'd like to keep in contract and go along down the road with us, maybe 6 months, and we'll wait and see where we kind of land. In terms of pricing, unique that when we're selling to a home buyer, oftentimes they buy based on monthly mortgage price, mortgage payment, as opposed to the actual cost of their home, right? So although we're certainly not seeing price growth, we're not necessarily seeing price reduction, but what we are seeing is for us to sell, we're having to put a lot more money into the financing arrangements for the home buyer, buying the interest rates down. What we've been able to teach the buyers is it's better for me to take an extra $10,000 and provide them with a better mortgage package, buy the interest rate down, prepay mortgage insurance, as opposed to just reducing the base price. And that's really what we're seeing in the residential market in terms of pricing.
Okay. How about the competitive landscape? We've seen that both on the home buyer side, if we get to kind of this, keep getting these kind of inflection points that the local buyers say, okay, I'm out, but I'm priced out. And then someone comes in from California, New York, and they're like, this is such a bargain, right? And they, that continues to kind of push these prices up. And even, that's on the end user side, and also rents, we're seeing the same thing, right? But also on the development side, we've seen something similar where local people are like, I can't pay that for this land. And someone comes in again from New York, California, and is like, what a deal. So how are you seeing your competitive landscape changing in terms of going out, looking for deals, and just overall supply coming to market?
Well, that's a great question. I think there's a lot of land acquisition opportunities still out there. Our biggest challenge we're finding is, wherever we're looking to develop, is it anti-growth or is it pro-growth from the local jurisdictions? And again, back to what Judd was saying, and also Tim, it's getting the land sellers back to reality as well too, and getting those prices back down. So I think there's plenty of opportunity out there. It's just finding it.
Right.
Yeah.
I mean, as far as, I didn't answer your earlier question, but about, rent growth, from a pro forma standpoint, we're underwriting 0 rent growth for 2 years. And then we'll do a 3% with expenses and rents going forward. I think that's relatively conservative. It's kind of the baseline, but kind of showing we're not showing any 8% increases or 15% increases. That being said, on our existing portfolio, and we own about half of our units and the rest are going to be merchant built, but we're seeing anywhere from, even today, currently a 5 to 8% rent on renewal rates, right now, just because, and we're seeing a slight, downtick in our occupancy, but not a whole lot that's causing us to say, let's go ahead and throw on concessions, to try and make everything work. So overall, we still think that there's a positive momentum, in the overall marketplace. We're seeing a resident retention, but one thing we are seeing is, even from in-migration, we were having about 50% of our new leases were from out-of-town folks. They were all coming from the Midwest or the Northeast. That has since dropped down to low 40s. So we expect that will continue to drop down, but even the job growth in most of the markets that we're in is still positive, and income growth is positive, and so we're still seeing more attrition on that, which is great.
Yeah, to kind of expand on what Judd just said, we're long-term holders. We're not merchant builders. Our plan is to hang on to our properties for 7, 10 years. With that in mind, our underwriting, we project 2% income growth over the first couple of years, and then we go to 2.5% beyond that. But to answer that question.
In terms of market audiences, the past 2 years we saw record number of first-time buyers, and that's really, in May, I think that train stopped. And then on the renter side, we see increasing rents, right, and a lot of renters by choice. So as we look out over the next year, who do you anticipate your market to be, and how could it be different than what we've seen in the past 2 years? I'd love to hear all of your perspectives on that.
Well, from Middleburg standpoint, since we're doing probably half of our stuff is a single family for rent. Some of them are standalone, but a couple of our communities, we actually have a combination of multifamily, traditional 4-story apartments right next door to our duplexes and cottages and townhomes. They share the same common property line. We're drawing from folks that want more privacy, want more space, and we build ours and design them with pods so that we surround grassed areas and amenities like that. And it attracts folks because, look, the way we look at our single family rentals is it's an apartment building pushed over, and it's horizontal. So you get all the same amenities, all the maintenance, all the on-site property management, not like you would in a scattered single family for rent that's, in different locations and so forth. So we really are just an apartment complex pushed over and spread across the ground.
I would say from a demographic, I think it's, pretty much the same almost everywhere except in certain locations, but about 60% of our renters are under 35. Our renters' incomes are roughly about, 80 to 100 grand a year. So income levels are pretty strong. So from a rent to income ratio, we're like in about the 24% range overall. But you've got another 40% of the market that has been increasing, where we see now a lot of retirees and a lot of the aging population, let's call it, that they are adding up to be a more significant portion of our demographic for renters. So what that means for us is, we start looking at some of the active adult communities and some of these, like the villages and other markets, just to kind of understand what's really driving, what are they looking for, as product is concerned. And so you got to think about how to design the product. And I think that's important for the demographic, where that percentage or that group of the population was 10% of our rental pool, is now going towards 30% of our rental pool. And that's a significant change in design and how you market the property, because you can't just market the property to social media. But the crux of them is still under 35 is 60+% of our renters.
A quick follow-up question for you before you answer, Tim. Judd, have you found then with that demographic, is there a greater expectation of community building, of kind of what those renters want and you need to deliver, not only in the actual unit space, but in the kind of overall lifestyle?
Yeah, there definitely is more. It's interesting. There's more interaction with sort of the older demographic with our leasing teams than there are with the younger demographic. And I don't know if that's just social or demographic or whatever it has to be, but it does go into how we design. I mean, we've started off, I'm sure it's no competitive secrets. Anyone can walk into our property and see what we do, but we've started adding in some for rent offices that people can rent as separately outside of their home, because we know work from home, 1/3 of the people or more are still renting, and still working from home. They don't want necessarily work out of their apartment. So we have seen with that addition that we've had most of our people who rent those offices are in their 40s to 50s. They want a place to work out of. So that's a significant change. They can actually have customers come to their own office with their sign on it. It's inside to the back side of or one of the sides of our clubhouse. So they have a little bit of space, their own conference room. And it's just one component of it, but it also even goes to the design of the amenities and how we design little more quiet areas. So it's not just the pool and the fire pit and the grilling station. We have to think about, do we just need some seating areas that are relatively quiet? So we have these things called quiet courtyards. So that ends up being used, what might be reading nooks or things like that. So it does absolutely go into the overall design of how we approach it.
And so, Tim, how are you gearing up for your buyers this year, and who do you think they'll be? And now that you've missed that piece of the pie of that first-time buyer, how's it influencing?
So we have a relatively wide, diverse customer mix. We don't anticipate a big shift in that, but what we do anticipate doing is having to design the homes a little bit to accommodate affordability. So oftentimes it means the targeted customer base we might be targeting a smaller square footage of home, maybe more density on a smaller lot. Maybe not, maybe base specifications are at a little bit more of a basic level to provide a more affordable home. But other than that, we would anticipate having a relatively similar mix that we always have had.
And so to hit a more affordable price point, I mean, are you all coming up with more dense product, smaller product, I imagine? I mean, what shifts are you all making specifically to try to hit that price point? Because we know the other pieces, the other variables, right? We've got labor, we've got land, fees. So really, it seems that's the part you can control, right? Your footprint. And are you seeing that shrinking? Are you offering up plans that are smaller, more dense? What solutions have you guys come up with?
Well, a lot of times it as you've mentioned, right? It's smaller product, more dense, but a lot of times it's even some of the architectural character, right? Every turn on an exterior or an elevation of a home creates more cost. So, to one extreme, you can talk about, a lot of builders will build what they call a value box, right? So you're building big square footage, and it's basically 4 square walls. And so I think you're seeing oftentimes, in order to get affordability down, a bit of reduction of the architectural character as well as the size and the density.
So Judd and David, I think we've seen this shift in multifamily where there's been much more we space and less me space. And so, your units, I think everyone's trying to get them tighter and tighter. Do you anticipate that being the continued trend? Particularly as you try to hit a price point for rentals, have you all seen a necessity to change your unit footprint at all?
I'll tell you what we're doing in Middleburg. We're going to a prototypical unit where we're using the same units over and over and over again. So obviously, all we have to do is call up our architect and have them pull it off the shelf and pay them a reuse fee. So that's one way we're reducing our cost. Plus, by building the same thing over and over again, our construction team becomes more efficient. As each project is being built, we get better at pricing and those kind of related things. We're also in our single family looking at panelizing or framing and working with panelization companies out there that panelize these things in-house and bring them out to the site and just nail them together. So we're finding a lot of efficiencies there too, as well. Because in our single family, we're trying to offer a little bit bigger unit, right? We're averaging about 1,200 square feet per unit versus in multifamily, you're probably at 988 or 975. So that's helping us a lot.
From our perspective, we look at the design of the building, of the amenities, of the club room, of the units themselves, more in I'll call it a psychographic way. And what I mean by that is, we all have a car that we drive because it's the one we want to drive. We wear our, hair a certain way. We have our clothes certain things, or a pair of shoes that we wear, red or not. It's a design that we choose that we want to be. So we go after the design process from our buildings and our units and our amenities, same exact way. We try to think like, and I always have this, we talk with the architects, say, yes, just give me something off the shelf. It never works, at least not for us. We're just not smart enough. We'll try. But we always tell our architects who put something together, I'm like, wait, where did that come from? Well, it came from Tennessee. And say, but we're in Florida. That doesn't work here. So we constantly have to challenge, what's being brought out. And I think as a collective, as developers, we've probably given more power to the architect to determine what that is. And we really look at ourselves, and the architects, I think, should look at themselves as anthropologists and really think, how do these people use this space? And that's how we come up with it. So our actual unit sizes for our buildings have increased. We've gone from what we were 940 to 980, 990, thereabouts, because we're responding to where the market is. An older demographic, they want a little bit larger. We got the work from home, they want a 1-bedroom den. We've increased a little bit on our clubhouse spaces. So all those are important as to how it's all put together, and we think how you end up selling that product to the customers.
I'd like to add on to that as well. One of the things that we learned really from the pandemic, and we had a lot of supply chain issues, was we had a difficult time providing a lot of the design selections people were asking for. So we reduced the amount of selections primarily out of necessity to be able to provide, instead of 100 refrigerators, we could get 8. So we would offer only those 8 refrigerators. Well, in working with our trade partners in keeping a smaller inventory on stock, by reducing the design selections, we've been able to help them reduce their cost of inventory and being able to supply those products. So that's kind of an innovation that's continued beyond the pandemic, but was really created out of necessity because of all the supply chain issues that we were having.
Well, so building on that, David mentioned that they're using panels as a cost reduction, and we know there's, builders exploring 3D printing. I was just reading an article in France that they're starting to use hemp blocks, hempcrete. We've seen extruded steel, concrete, prefabricated. So is there anything that, Judd, that you and Tim have been able to use at a scale to, as a cost savings to integrate into your plans?
Excuse me. I would say we've done panelization. We did it about 6-7 years ago, and I think it's still in its infancy. Excuse me. The challenge is most of the construction guys who are building from ground up stick, they don't understand there's a different quality control procedure that goes along with it. So that's a bit of the challenge that people are learning. It's supposed to be faster. Cost-wise, it really hasn't been a huge cost savings yet. We're doing it on a fourth project right now. We are eventually believe that the manufacturing process will improve and get us there. So that's about the only thing that we've seen. I mean, as we touched on with the supply chain, it was a disaster last year. I mean, even 2 years ago, what we, went to all of our contractors and said, bring everything on the job site. I will personally pay for any storage offsite and for double handling that you need, because we just want to make sure we had product. And I'm glad we did, because some of my competitors, they couldn't get things. I mean, we had to change designs of units because we had always designed to a Whirlpool appliances, and that wasn't available. You couldn't get the delivery. So we had to switch to KitchenAid. And in the apartment industry, you have to be careful because of the depth of the refrigerators. They're not all exactly the same. They're all off by an inch or two, and you're trying to maximize the space. All of a sudden, you've got 88 clearances that you need to meet that you're off by 1 inch. So it creates a cascading domino disaster. So from a materials, really the only thing we've tried is the panelization. We've looked at other components. We've done some precast. We looked at precast stair towers. It's kind of, I think everyone's done that. We're doing that. We do that for the elevator shafts. But as it relates to other components, that's about it that we've looked at right now.
Okay.
Yeah, we've had a similar experience as Judd related. Panelization is something that we've experimented with. We've tried. I think you're right. It is in its infancy still. We really didn't envision any significant cost savings. We had the same labor challenges. So I think until there is a cost advantage to doing it, it's going to kind of lag behind.
Okay. Changing gears a little bit, on the deals that you are bringing to market now, have you had to explore different lending sources or how your capital stack is made up as rates have gone up? How has that changed things for you?
Well, the debt side is the challenge these days. There's plenty of equity out there that we're finding, but the lenders are the first guys to kind of put their hands in their pocket and throttle it back a little bit. It's interesting too, because I know that one of your questions was about, how do lenders and the money sources dictate your project or your development. Funny enough that you mentioned, you asked that, because we have a project starting right now that's a combination of multifamily and single family. We have one prime equity partner that's involved with both of those projects. The prime equity, as a lot of you know, a lot of times control your business and tell you what to do. They wanted to do the SFR, the cottages in the single family community first. So we went out and sourced a debt lender who agreed to do that. And then about halfway through, the equity partners decided they wanted to pivot and go do the multifamily first. That particular lender that we had in tow for the single family decided, well, they didn't want to do the multifamily, so they backed out. So then we had to turn around and go find another debt lender to do the multifamily. So, it's whatever the debt lenders are comfortable with, especially in these times of economic uncertainty, as to what. So I guess my point is that, yeah, money is dictating a little bit about what we're doing and our strategy.
Yeah.
Yeah.
I mean, capital is the most important aspect of our business. It's the single biggest focus that we have besides construction costs that we work with. Our lenders we've been working with for 10 plus years. Our equity sources, we don't have that many equity sources that we use, but we talk to a lot of folks. We're probably a lot more scrappy since we're a smaller firm. and we're very limited on the number of developments that we want to do. So we do some private raises as well. So where in the past we were raising anywhere from $8 to $20 million privately, we thought it would take us 3 weeks to get that done, and we'd have it done in 3 days. So that was in the past. I expect that now to be a lot harder. I wouldn't want to go out on a $20 million private raise today. I think that would be a lot harder to do. On the equity side, from everyone that we've talked to, I mean, I'm going to want to see who your equity partners are, because all we're hearing is that they're shut down on JV equity and they're doing rescue capital or looking for preferred deals because they're waiting for some distress in the multifamily marketplace. So the debt is controlled by credit right now. And, kind of like when I started the company back in 2009, one of the lenders I went to said, Judd, I love you, but unless you've got $20 million in the bank and $100 million net worth, and we've got an operating loan with you today that's not losing money, I'm not sure we'd still lend to you. So it's not quite that bad, but it's certainly in the vein of that right now, where they're all worried about what their capital ratios are, because they can't get a lot of these loans off the book, construction loans. So they stay on the books as construction loans, even though as they're operating. So that's one big thing that we hear about, from our lenders. And the 3 or 4 guys I spoke to last week, they're all out trying to get deposits so that they get their capital ratios up, because commercial real estate is still stuck on their books. So, all I care about is you get enough deposits so you can do my next deal. So hopefully that's going to be a yes in a few weeks. But
It really comes down to relationships now.
Yeah.
It's relationship banking and equity. That's why we're still able to raise our equity. So I'll keep that close to my vest.
So I'm fortunate enough, our U.S. operation of Mattamy Homes is owned by Mattamy Asset Management, which is a company out of Toronto, Canada. It's backed by a high wealth individual, and from a capital raising, we've had sufficient capital to continue with our available lines of credit. So we've really not had to go and access the credit market or the equity market. But again, as I mentioned before, if you look at it from our end home users' perspective, the type of lending they need to get, I think, has changed dramatically because of the increase in the interest rates, right? And again, we're always on the lookout for loan products that will reduce the monthly payment for the home buyer, and creative ways to help a home buyer get a loan product that will make their monthly payment, easier to digest, whether that's an adjustable rate mortgage, which when interest rates were 3%, there was no need to do adjustable rate mortgages, right? Money was virtually free then, but now, we're purchasing forward commitment money in order to lock in and just kind of hedge on the interest. So, we're always looking for creative ways to help give our home buyer the most affordable monthly payment, because that's really how we sell houses more than what the selling price ultimately is.
Okay. Before I turn it over to the audience for questions, my last question for you all is, what do you think the most surprising thing will be about this year?
I'm sorry,
What do you think the most surprising thing will be about this year?
about this upcoming year?
Mm-hmm.
you want to start there, Tim?
I think that it's, we use this term green shoots, right? And we've seen some encouraging signs most recently in terms of our home sales, right? And I think that unlike some of the previous housing downturns, one of the big differences today is the supply of homes on the market there's not a glut of supply. There's still a very small supply of homes. And I think we'll find that the market will be surprisingly healthy. At least the residential market will be surprisingly healthy through the rest of the year.
Okay.
I mean, from our perspective, I'm the worst timer and worst predictor in the market, even though I still attempt to do it. We think that there's probably going to be a recession at some point. But the difference on the development side and the way we look at it, I think one of the speakers had talked about timing. Timing's really tough to do, but from recessions, the shortest recession since like 1940s has been like 8 months, and the longest one's been 16 months, and the average is about 11. So from a development standpoint of a typical 250 unit apartment project, it takes approximately 20 months just from the construction start to completion to get done, not to mention all the pre-development stuff. So as long as we're not delivering into a recession, of course, I'm delivering one right now that'll be coming into a recession, not hopefully, but that's the concern overall. But as far as 2023, there was a headline in Globe Street yesterday or the day before that said something to the effect of multifamily will not see, any problems going forward. And I kind of look at that as like, God, is this like the Business Week, Forbes, Fortune, Financial Times, Economist, where it shows up on the front cover that that's going to be the problem? I think some of the issues that we'll see this year that will come to light more towards the end of the year, there were a lot of deals that got done at high price points, and they're going to be underwater come towards the end of the year. So, but long term, Florida's great. I mean, you look out 5 years, population growth, household growth, income growth, even with a recession, it's still going to be net positive.
Look, there's 1,000 people a day moving to Florida. I'll be surprised if KC's wrong for this year. I think we're in a great position here in Florida. And I was just on a development manager's call yesterday with our company, and our other regional managing directors in different parts of the country are just all jealous of us down here in Florida. So I think we're in the best shape of anybody.
Great. All right. Any questions in the audience? See if you're Carson.
This for David. I see kind of on the internet what you're building by these knocked over apartments are more cottage style apartments than a typical tract home development, correct? So how is your customer different? How do you get a point of differentiation from somebody being able to live in a Mattamy Homes type suburban townhouse or rental community? What's your differentiation point you find for this tighter cottage development?
Well, we're drawing from people who want more privacy, want some yards, a lot of our draws from multifamily renters. I'm not sure that quite answers your question, but to be honest with you, I mean, this is kind of a new horizon for us as well, going into the single family. So we have not completed one as of yet, but we've got probably half a dozen of them. We've got 2 of them in Florida and several throughout the Carolinas and one in Alabama and Huntsville that are starting. So, it's a learning process for us as well. So we'll see. But I think the draw is folks that are just tired of living in apartments. Interest rates are going up. They can't afford single family homes. And we're drawing also from a few folks that live in single families that are scattered around the community into one community that's managed, professionally managed, on site, has all the amenities of a Class A apartment. I hope that answers your question.
Well, it's interesting from a market side, and Judd, I'd be interested to get your perspective on this too, but when you look at renters and what they're looking for, one of the big things is soundproofing. And, I think that's a big motivator of the build for rent that you've got, some are attached, there's the duplex situation, but I think having that detached unit of soundproofing assurance and a private yard, those seem to be the major motivators that we see, that differentiator between the two.
Yeah, it really is. Yeah.
Yeah, I agree. I mean, that's something we focus on with our apartments. I came from the condo world, which it's a bad term, right? We always did, and we still do, surveys on all of our residents. Number one concern is security, and number two concern is sound. Obviously, an apartment between sidewalls and upper and lower, that becomes a concern. So we spend a lot of time making sure that we exceed STC ratings that you would have in a home. What we've seen, because we've studied a lot and we have an equity partner who's advanced a lot of money into the build for rent market, is that it's an older demographic. They've been in the 36 to 38 range as opposed to in apartments might be 32 range or even older. And the incomes are higher, so it's definitely better. But sound it's number 2.
Another question in the back there?
Yeah, I just wanted to ask the panel, as we all in the multifamily industry try and achieve higher yields out of the same rent and the same construction cost. What are you doing on the expense side to innovate, adapt, reduce, and make up ground to make deals work in today's market?
Well, I'll tell you from our perspective, we don't believe our costs are we believe our costs are better than all of our competitors. And we hear about it from our lenders as well, and people ask, well, how do you get there? How do you do it? I'd probably take a page out of Elon Musk's book. I could be so egotistical to say that, but he always talked about first principles and going back to understanding. So that's where we start, with all of our subs. We work and they give us a number like, okay, well, give us a raw price and let's get back into that, understanding where that is and how is it put together and is there a more efficient way of doing it? Because again, going back to the architects, I love them, they have a purpose and we get code-approved drawings, but they don't necessarily understand how the subcontractor is putting it all together. So from our perspective, we bring in everyone early. And, we have at least a good success of being able to 97% of closing all of our deals that they've seen. But that's been a single biggest factor of saying, well, how do you put it together? What is this component here where we can end up taking out 1% to 2% of the inefficiencies on 16 divisions that's out there? That has a huge impact overall, on the pricing. So we question everything. I mean, we argue a lot with our general contractors saying, well, tell me what the general conditions are, and they give you a lump sum. Like, no, let's get down into the the details of it. What the people are and all that kind of good stuff. Those are the challenges. I mean. Someone quoted recently, and I've been using it a lot. I should footnote them at some point, but incentives trump, ethics, and a lot of the, the designs of the construction contracts really have that. And it's not that it's just the way the industry's been done. I mean, construction industry has I think it's a negative productivity improvement over the last 10 years. There was a big McKinsey study on it. But that's one of the biggest things that we focus on because from our budget standpoint, 65 to 70% of our costs, from a development budget, is construction costs.
Yeah, I would agree, and that doesn't really, I don't think that really answers your question on how we reduce our operating expenses. And I don't think you can only streamline operating expenses and manage them to a certain point. And I totally agree with Judd that where you're going to get your returns and your yields is your upfront work, your design, your construction. And we're fortunate enough to have our construction in-house, so we work shoulder to shoulder with them on a daily basis on our development side and come up with the best solutions and get the best prices out there.
All right. Anyone else? All right. Oh, I'm sorry, you have a question? No.
You shared the rent trending on the income side, and how are you handling the trending on your operating expenses as far as the controllable expenses and the non-controllable expenses such as your taxes and insurance?
Did you hear that?
So was your question, just to restate it, you were saying how do you control the portion of your rent that goes to taxes and
Trending
insurance?
forecasting on your operating expenses, both controlled and non-controlled. Because you mentioned, one of you mentioned that you're doing 0%
That was Judd.
rent increase for the first 2 years and 2% thereon. And I think it was David that said 2% starting year 1 and 2.5 year 3 and on.
Correct.
So what are you doing from an operating expense standpoint?
2% on our side. Just every year, we figure 2% operating expense increases.
Yeah, we assume 3. The biggest, I'll call it disaster right now that we're having is insurance. From the construction side, our insurance builder's risk has gone up 3x. On the operating side, where we typically underwrite, $400, $500, $600 a unit for insurance, is now, $1,800 a unit. And that goes right to the bottom line. That takes out. So that's a huge impact that we don't have control over whatsoever. We have shopped around to, a number of the insurance guys. Taxes are up, because obviously the market has done so well, so there'll be a lag before it starts reducing again. But the biggest impact for us has been insurance and taxes. from a payroll standpoint, it's gone up, but it hasn't gone up anywhere near the extent that taxes and insurance have.
And that bump's just happened since the last season of hurricanes.
Yeah, it did. Last 6
and,
months, it's been a
And I
killer.
totally concur. That's, in Florida, insurance is a biggie.
Yep.
So we also project similar annual increases for costs. One of the, we think, more impactful changes that we can make is our cycle time, the time it takes to start from the start of a home to the completion of a home. If we used to be able to build a home in 120 days, and 6 months ago with all the supply chain issues, it ballooned to 240, 270 days, and having all that inventory on your books is a huge drag on your P&L, and you're missing out on the opportunity of the cash when you actually close on the home too. So there's other ways between the obvious labor and cost of materials, and really time is a huge element in terms of what our profitability can be. So it's as important as controlling your trade partners and your material costs, quite frankly.
To just touch on one point, you had asked about how you control things. I mean, I wouldn't call it innovative, following sort of Camden or MAA or UDR. One thing they have done, and we've implemented as well, is, and we did it during the pandemic, is virtual leasing, but that's become a more significant portion, and that helps reduce costs because I might not have, one less leasing agent. But we've also looked at and did a lot of study across all of our properties that, when are all of our traffic coming in? And then trying to see what's the best time frames that we could, structure our employees' time to be, because normally everyone's open 7 days. So we cut back where we're now only open 6 days, and Sundays are off. So it's giving a little bit more consistency and things like that. On the construction side, we go back and we've looked at all of our projects that we currently own and have owned and see what was the impact of maintenance, and looking at are there things that we could do in the design phase to try to minimize that. And that goes back to the efficiencies of how the whole project gets put together. So, I mean, we all know that once you build it, and if you're selling it, I'm not worried about it, but we are. We want to build a good product, and we own a lot of our product as well. So those things have a huge impact on how the property gets managed and what those maintenance expenses might be. So even a $25 reduction in our maintenance expense per unit, across a property has a significant impact. So we're trying to look for all those.
Judd, I'm curious, which day did you take out of your staffing schedule when you went from 7 to 6?
I'm 7 days a week, but
You are 7 days a week? Okay. Fair enough.
yeah, my wife says the same thing.
I hear you.
No, I'd just like to add to what Tim was saying. I mean, timing during construction is super important, because in the multifamily business, I mean, for every month that you're running late, or it's $100,000 to $130,000 a month just in GCs and general conditions. So if you can shave a couple months there, you're talking about a lot of money,
Yeah.
and it goes to the bottom line. Yeah.
Great. Well, thank you all so much.